Hey, welcome back. One of my walking videos, unfortunately today it's so hot. It's over 40 degrees, 100 degrees Fahrenheit. So I've decided to sit. I'm actually at the rooftop in my penthouse in Madrid. So I'm going to start off with the recent price action movement that we've been seeing this week in Bitcoin. It's July 4th and it's currently trading around $109,000 to $110,000 per coin, just shy of its all-time high. Momentum is being driven by equity strength, monetary expansion, and macro policy deterioration. These are the key ingredients that would enable more investors to move away their wealth from fiat, from TradeFi, from decentralized authorities into Bitcoin. Institutional inflows continue. Market structure suggests another parabolic move may be in the play. So as capital flows in, crypto's darker side is making headlines again. Unfortunately, every other day, if not every day, on hacking incidents. So this one is to do with the hackers behind $140 million Brazilian bank heist are laundering funds via Bitcoin and digital assets. This highlights crypto's role, not just in innovation, but in digital age financial crime. Regulatory scrutiny will tighten. Self-custody protocols and compliant exchanges become mission critical. For me, I mentioned about the need to strengthen crypto exchanges because they do host customers' digital asset holdings. But in one of my podcast series called Crypto Vault, I've always been advocating for self-custody because that is the true self-sovereign way to protect your digital wealth against any centralized authorities, whether it's crypto exchanges, financial institutions, because if you're thinking about, as I am, holding onto my crypto wealth, whether it's Bitcoin, it could be Solana, XRP, and you're seeing it into the long term, then you need to really adopt self-custody. There's no other shortcut other than self-custody. So if you subscribe to my channel, do have a peek at that Crypto Vault podcast series, which actually gives you the latest scam techniques that I've been seeing, where they've been targeting not just the elderly, but in fact all age groups and in all walks of life, and indeed across the world. It's not just something that's akin to the Western world, it is actually akin to everyone. So that is the point here. Now this leads into the next interesting story that we might have been hearing an awful lot about, is this famous big beautiful bill that's been recently passed by President Trump. Now the original amendment to that bill was actually did accommodate the actual crypto gains exemption for a small amount of Bitcoin payments. I think it was under $600. But unfortunately, there's been a sweeping crypto tax bill that's been brought back and now is actually seen as a standalone. So the passing of the Big Beautiful Bill Act has actually, in its final version, has taken that out, which in fact, in my honest opinion, it's a lost opportunity because, again, in many of my videos in my channel, I've always been arguing that governments around the world, they need to do a complete overhaul of their tax system because given the digital era that we're in, it just doesn't make sense to apply the same sort of tax burden, whether it's income tax, capital gains tax, wealth tax, inheritance tax. There's got to be more tax efficient way to bring down the burden in order to entice individuals to move into those countries that have more favorable crypto tax regulation, tax laws, in order to attract, as I said, those high net worth digital asset individuals, the fintech players that the governments need in order to prosper the digital assets industry in their own territories. But anyway, that's for me is a lost opportunity, but I'm sure that at some stage there'll be countries out there, particularly those that are already ahead of the pack, like the Middle East. We all know that the Middle East is famous for 0% taxation, even though it's not exactly like that. But it's just a question of a catch-up for the rest of the territories to do that overhauling of their tax regime to make it more tax efficient, to bring in those high net worth individuals, the fintech players, and so on. Now, this brings into the next point about the IMF just drew a very different kind of red line in the case of Pakistan. So Pakistan has asked the IMF, the International Monetary Fund, to subsidize electricity for Bitcoin mining. This request unfortunately got rejected. The IMF isn't ready to sponsor crypto economics in vulnerable nations. Again, as with the previous point on crypto tax regulation, this is another lost opportunity, because there was an interesting interview made by Fred Thiel, who, if you don't know, is the CEO of Mara, the leading US Bitcoin mining company, where he's shared some rather interesting insights around the future prospect of the Bitcoin mining, because it's true that given the growing scarcity, there's going to be fewer Bitcoin mining rewards as we're approaching the zero mining rewards I think by the year 2140. So there'll be less of a potential for Bitcoin miners or mining companies to get more Bitcoin rewards, but they will make up for increased fees, because the capacity on the Bitcoin network to be able to transact is going to become even more expensive, because there'll be more demand to be able to transact, whether it's at the base layer 1 or the layer 2s. They'll be able to make up the difference through increased fees. So on that side, the profitability for Bitcoin miners will continue, and would also become more resilient, because there'll be more node participants, there'll be more Bitcoin miners coming into the ecosystem, which will help the security of the Bitcoin network become more resilient, thereby increasing the hash rate, which is like the way of safeguarding and making the Bitcoin ecosystem more secure and more resilient against hacks. But he's actually shared some rather interesting insights that in the case of energy, he sees there is that clear dichotomy between Bitcoin mining rigs tapping into particularly in the emerging economies, where they have an awful lot of cheap energy supplies, if not near to 0% cost of energy. So we're seeing a plethora of Bitcoin miners settling in more developing countries, like in Africa. I made a video on that same example, which I would encourage you to view. And also there are other economies, right, other developing nations where they're doing the same thing. And that for them is like the perfect entry point. But it would also help the developing nations to actually participate, to mine Bitcoins by setting up their own mining rigs in those territories, because of the fact that they have this kind of a special nuance or advantage given their cheap energy resource supply to mine new Bitcoin. So there is clearly a dichotomy between the energy industry and Bitcoin mining rigs, and this is the key point that this Fred Thiel has actually explained, which makes total sense. And also, for me, there is a third element where there's this narrative between Bitcoin mining and AI, because the high power compute data centers that are using AI chips for their own businesses, well, they are struggling to find cheap energy resource supplies or the capacity to be able to plug in energy at a much affordable rate. And also they don't have the infrastructure to be able to process that. So what they're trying to do is positioning the Bitcoin mining companies who already have the chips, the infrastructure, in order to plug in to the cheap energy resource supplies, in order to pass that energy, processed energy, to the HPC data centers, because they also emit energy as a result of mining your Bitcoin. So you can see that the Bitcoin mining companies are finding ways how they can get themselves more immersed into this highly profitable, highly lucrative digital economy. So I find this a lost opportunity, and it's probably hardly surprising given that the IMF is pretty much TradeFi, is part of this corrupt, centralized institution, and they feel kind of a threat. Anything that they may hear about Bitcoin or indeed digital assets, well, for them perhaps is a red alert, and they try to kind of divorce themselves away, which is a shame, because for me, digital assets is the most important growth industries out there in the world that can bring prosperity at a much more egalitarian basis for nation states, individuals. So this brings into this next point about where Anthony Scaramucci, if you don't know, he is the CEO of Skybridge, is an American investment firm. He used to be the White House communications director in the first President Trump period at office. And he's made some interesting remarks about where he said that the corporate Bitcoin treasury strategy, which as we all know has been pioneered by Michael Saylor, and strategy may not scale. But sovereigns and private equity don't advertise their moves in real time, which is true. Whether you agree with Anthony or not on that point, I beg to differ, because we are seeing more companies, whether they're public or private entities, adopting the Bitcoin strategy because they can see, based on numbers and based on data, that many Bitcoin treasury companies have adopted that strategy, and they are becoming the leading stock in a country. Take the example of Metaplanet, the leading Japanese company, where they've actually adopted this strategy, this Bitcoin strategy, whereby they've issued their own stock as debt in order to capture the capital, in order to invest into Bitcoin and store it in their corporate treasury reserve. That is the Bitcoin treasury strategy. So I beg to differ on Anthony there. I think there is still many more months and years for this strategy to continue, where a lot of companies who may find themselves in a difficult situation where they are like zombie-like, where their core businesses aren't yielding an attractive rate of return for their stakeholders, well, they have that opportunity to invest into Bitcoin and copycat what Michael Saylor has set out for public companies. Now, there are over 150 public registered companies out there in the world who've adopted the Bitcoin strategy itself, and it's growing. So I beg to differ. There is still some leeway there, because we're seeing news pretty much every other day of another company adopting the Bitcoin treasury strategy as a result. And also, in addition to that, there are Bitcoin development companies. Take the example of 21 Capital. Again, I made a few videos on that, where they're trying to position financial products, where they're trying to provide yield, particularly to those Bitcoin hodlers, where they are facing that dilemma of when they hold their Bitcoin holdings under self-custody, let's say, they're not really yielding anything. So what the Jack Mallers and 21 Capital are doing, they're providing a financial product means where they can use their Bitcoin holders as collateral in order to take out a fiat loan, which is interesting. But like I said, there is a caveat in there that for me, 21 Capital still remains a counterparty risk. But nevertheless, they're trying to find innovative ways in order to help the Bitcoin holders' dilemma, in order to help them generate yield without actually parting with their Bitcoin holders, which I find interesting. Okay, so this moves on to the next point about BlackRock's Bitcoin ETF now generates more revenue than its S&P 500 fund. That's not an anomaly, that's a signal. So the impact there is institutional credibility of Bitcoin has crossed the threshold. So we should expect, or will expect, to see more ETF demand to accelerate. Now, with that demand, the SEC just widened the pipeline for more passive crypto exposure. Recently this week, the SEC has approved Grayscale's diversified ETF fund, which now includes Bitcoin, Ethereum, XRP, Solana, and Cardano. This isn't just altcoin access, it's a regulatory green light. Now, this is quite important, because this is actually in line, if you recall, the executive order which has been signed by President Trump back in January earlier this year when he arrived back in office for his second term. If you recall, he's actually signed off an EO on strategic reserve for leading digital assets, predominantly Bitcoin, XRP, Ethereum, and Solana. So this makes perfect sense, in that this is in line with what these asset managers are doing, right? They're trying to prepare those ETFs, more diversified crypto ETFs, particularly in line with the strategic reserve assets signed off by President Trump. So we're going to be seeing more diversified crypto ETFs being spring up as a result. So this is good news in the sense that it's going to draw in even more capital for those institutional players who are not in a position, if you like, to invest directly on chain. They need to use their ETF, because these companies, I used to be an auditor, so I know how painstaking it is for them to be able to do that directly, which is why these ETF products exist, right? Because they have a lot of compliance due diligence to satisfy their stakeholders, their corporate executives in the company. So this makes total sense, and it's good news all round, right? In order to draw in, as I said before, more liquidity, more capital into these diversified crypto ETF funds. So we're going to be seeing an awful lot more of this in the months and years ahead. Which brings into my next point about Pantera. and Ondo Finance are going active to the tune of $250 million. So Pantera and Ondo Finance are teaming up to deploy $250 million into tokenized private credit. This isn't just speculative yield. This is on-chain infrastructure for real-world income. Now, again, I made a video on what is Ondo Finance. So they are the leaders in tokenized treasuries. What they're trying to do is not just limit themselves into tokenized, let's say, US treasuries on chain. What they're trying to do is look on the other side of the fence to tokenize private credit on chain, on the blockchain. You know, it makes total sense, right? Because there are a lot of institutional lenders who are into the private credit space who, again, they have the same predicament on how to make their products more investable and less illiquid. And the only way to achieve that is to even tokenize private credit, where they're playing catch up with tokenized treasuries, because we all know that from governments, and they are kind of desperate, if you like, in these times where they're trying to find more avenues to entice more capital inflows to service their national debts. Well, the same can be true for tokenizing private credit. So we're going to be seeing exhilaration in this RWA trend space, legitimizing tokenized credit. So now let's zoom out a bit and let's turn ourselves to another part of the region where the Middle East just gave us a sovereign grade signal on real world asset tokenization. Abu Dhabi Ventures is tokenizing national bonds, not as a pilot, but as live issuance infrastructure. So we should expect institutional capital to follow. It's a clear shift towards regulated, scalable RWA rails. So, as a final takeaway from this week, I know I've covered an awful lot of topics because, you know, we are seeing a lot of changes in the crypto industry at large, particularly within the real world asset tokenization. As you can see, I've talked an awful lot about what's emerging in RWA and why we should pay attention to what's happening, which is all the more reason why you should subscribe to my channel, because I have a separate podcast series exclusively talking on RWA, which is called RWA Revolution. So if you haven't seen it, I encourage you to tap into that podcast series and just find out what's emerging. What is that innovative or next use case that we need to worry about from an investment perspective, because there is that investment potential for real world assets tokenization. Because, as I said in many of my videos, there is a lot of estimates by 2034, 2035, where real world assets as an industry is poised to becoming that $10 trillion plus market cap industry. So for that reason, we shouldn't ignore that mega trend. So we need to stay ahead. And if you subscribe to my channel, I will give you the breakdown that you need to know in terms of what is out there, what is emerging, what is that next RWA coin project that we need to at least be made aware about, and then leave it up to your judgment to do that research that you need to do before you invest any of your fiat wealth into it. So that's all I have for you today. If you enjoyed today's episode, please don't forget to like button, to share the video to your colleagues and friends, and if you haven't done so already, please subscribe to my channel, as I regularly publish some interesting videos such as these, anything to do with Bitcoin, blockchain technology, and the future of finance. So till next time.